Grow an actively managed portfolio of gold, silver, platinum, palladium, and rhodium with Auctus metals today.
you know, Most people are sometimes, ignoring the fact that globally we're seeing one of the biggest increases of money supply we've seen in history, and it's driven all over the world. It's not just the US.
Hello, everyone, and welcome to the Auctus Edge, powered by Auctus Metals Portfolio. I'm your host, Patrick Vieira. At Auctus Metals Portfolio, we actively manage and optimize precious metals portfolios built with gold, silver, platinum, palladium, and rhodium. Come see us and learn more about it at www.auctusmetals.com today. And joining us today is macro strategist Tavi Costa from Crescat Capital. Tavi has been featured in financial publications such as Bloomberg, the Wall Street Journal, Reuters, Yahoo Finance, Real Vision, and others. And I want to welcome and thank him for sharing his insights on the Octus Edge. Tavi, welcome, and how are you doing?
I'm very good. Thanks for having me, Patrick.
Glad to have you on. Really glad to have you on. I want to first start off with the recent tweet you had posted on your X account at Tavi Costa. You posted the Chinese central bank has effectively resumed quantitative easing. While the scale of the net purchase may not be significant yet, the policy shift itself is highly meaningful. Tavi, could you let us know what you're seeing with this Chinese central bank shift?
Yeah, it's a broader issue happening worldwide, and certainly some of the commentaries have been very targeted towards the US economy, given the fact of how much debt uh, the American economy has currently from a government standpoint, and how much it has to actually find solutions when it comes to buyers of those treasuries as they continue to grow their balance sheet on the debt front. I think the same is occurring in other countries, and China is definitely one of those that often, are not mentioned. But China alone has added about $10 trillion to their money supply just in the last 2 years, and that's an enormous amount. I mean, the U.S., for instance, has added a marginal amount relative to that. It's like 11 times more, and so to me, that's where most people are sometimes ignoring the fact that globally we're seeing one of the biggest increases of money supply we've seen in history, and it's driven all over the world. It's not just the US. That doesn't make the US a better place. That doesn't make China also a worse place. It just means that we're clearly facing a global debt crisis that is also forcing these institutions to become their own buyers of last resort. And as we see that being the case, when you have volatile moments like we had yesterday in markets, not to time this interview, but we're going to have more of those, and that's normal. And what we have to actually have conviction on is that on news like yesterday on the PBOC side are exactly what gives us conviction to stick with our plan of investing in hard assets over the long term. Like that's really what it boils down to.
Okay, yeah, I'll get to that hard asset comment shortly. With Asia, it is getting pretty interesting in that, not just China, but recently we saw other consumers of precious metals, India, with substantial imports of gold. So I want to ask you, why, in your view, are we seeing Indian numbers for precious metals ramping up?
Look, India has been going through a transformation as well, which is quite interesting. And I'm not sure if your viewers have seen this, but there's also changes on the silver aspect of that in their economy. Gold has been always very used for many reasons. Is one of the societies that truly understands the need for owning gold as a way to protect wealth, as a way to protect debasement of currencies over the years and over centuries. And what is fascinating about this is what's happening as well with silver. They're basically bringing back silver as money, as a form of money, into their own society by collateralizing, allowing the country to collateralize silver. And when you think about it, that's precisely where you want to be doing where you want to be focused on when it comes to the inequality issues of the country. Who owns the largest amounts of silver in the country are certainly the lower classes of the society, and giving them the chance to use that as a collateral to increase their uh, purchasing power overall, using a 1 to I think it's 11 or 13 ratio on the gold to silver lending difference is a clearly a move towards something that actually more meaningful in the aspect of how much it's likely to unleash of not only demand for collateralizing their own silver, but also unleashing capital that is going to flow back into their economy through consumption. And so I think we're going to see more of that over time. And there is a clear incentive by their government to allow that to occur more and more in order to really boost their economy overall and fix inequality issues, which was one of the countries that have some of the most severe inequality problems in the world today. And so it's fascinating. I mean, and the gold aspect of imports of gold surging are pretty much in line with that as well. I mean, it's exactly the type of importance of news that I think is worth mentioning. I use my Twitter account or my X account these days to really share those, what I think it's, the importance of some of the things that are changing every day. And sometimes we get caught up in market prices and all sorts of things, but there's a clear strategy behind these posts, which to me is important to sort of take the noise out of the equation and really focus on the big picture.
Yeah, Tavi, I think that's why a lot of people do appreciate your tweets and a lot of your expert commentaries because of exactly that. One more question here with Asia. We saw recently some AI stocks take a sizable hit with SoftBank Group plunging some 14%. Tavi, overall, are AI stocks in a bubble?
Um, so I think this is a very important question. I do think have a valuation problem, which means they're in a bubble. I also think that for us investors in the mining industry, we have to understand what that means. And basically, the reason why I think these companies could be under a lot of pressure is especially because of how their balance sheets may deteriorate and how they may actually change the way they're spending capital. I'll explain a little bit more about this. Basically, if you look at most of these companies, the Mag 7, the traditional Mag 7, for instance, they're probably generating about 600 billion dollars worth of cash flows every year. And then there's two parts of the equation that are very important here. There's about 2 to 300 billion that they are spending on capex, and another 2 to 300 billion that they're basically using to do buybacks, buying back their own stock, repurchasing equity, or dividends. And so when I hear the commentaries out there that people are saying that these companies are going to hit a wall and they're not going to be able to spend more, I think that's very wrong. That's very, very, very wrong. They can simply say, look, we're not going to do more buybacks and we're not going to do more dividends. And we have another a $250 billion. It's actually more than that every year to spend on capex. Think about that. Um, and then there's another aspect of all this. Do you know how much debt they have in as an aggregate of all these Mag 7 companies? Zero. They actually have net uh, cash today in their balance sheet of about $30 billion or so. So I know Meta took 30 billion in debt, but that doesn't change the equation. So the way we need to think about as investors in materials as a sector is that these companies can easily go to a 30-40% leverage in the next 5 to 10 years. Think about, if they have about $3 to $4 trillion worth of their balance sheets today. And we got to think about what's their balance sheet going to look like 5 to 10 years from now. It's going to have a very large debt component, and all that capital is going to go from tech into rotating to other parts of the economy that will provide the infrastructure that will be necessary for them to work in their AI projects. And so I am focused on the rotation aspect. And I also think that the big question is how will the market um, appropriately, value these companies if you see a major deterioration in their balance sheets by, you know, what I just said, by the magnitude of 30 to 40% of their assets being actually debt. So, yeah, that's the big question. No doubt the valuation is egregious and very bubbly. I don't think they can stay here at these levels personally. Um, but I also think that their spending capacity is at its early stages, and that has been extremely misreported out there. I've heard even on Barron's like over the weekend them talking about how these companies are basically hitting a wall because 80 or 90% of their cash flows were being used for capex. What they didn't say is that, or they did say, but they put in the footnotes, is that they're excluding buybacks and dividends. Who does that? Guys, all you need to do is say, hey, shareholders, we're not going to do dividends, we're not going to do buybacks. Many companies do that. Mag 7 companies, this is a new thing. Mag 7 companies did not used to pay dividends and buybacks to the degree that they're doing now. So it's a very wrong analysis in my view. Very, very wrong. So they're just starting to spend capital, in my view. I think that's the contrarian take of what's happening. Again, that doesn't mean they're great companies in an environment where there's overspending and they're going to become less efficient in their business and they're taking so much risk for spending too much and not getting any returns on on those investments. And so those are more important questions than saying that these companies are about to hit a wall of spending.
Okay, yeah. So I guess some of that spending or maybe that money is going
Yes.
to have to rotate into things I guess like the data
Yeah.
centers and especially the
Yeah.
energy for
Most
the
likely.
energy consumption that these data centers take. Okay. All right. I'll move over into metals. I saw an interesting comment that you posted on your X account as well, where Robin Brooks posted that the precious metals bubble is clearly bursting. And he noted that recent decline in the prices of gold, silver, platinum, and palladium, while the USD was relatively stable. Tavi, what's your opinion on that statement?
Um, to be very respectful with the guy, I don't even know how to start. Um, I think it's a very bad take, what he said. It's such a short-term view about what's been happening. And look, I reported once before about how foreign central banks now own more gold than treasuries, but that trend is just getting started. We're seeing that change happen mostly because of the change in gold prices, not so much about the gold accumulation. And we're yet to see that ownership of gold jump to 70, 80% of the central bank's balance sheets, remains at a 20% handle or 2% or two handle on their balance sheets. And I don't think that would be the case. So if you think about in that sense, we've got multiples of gold prices um, from where we are today to potentially get to. And calling this a bubble, I saw another macro economist say that gold is in a bubble if you looked at gold prices relative to CPI. I mean, we can get in a whole conversation about CPI. I'm not going to go there. But if you're going to call gold a bubble because relative to CPI, we are at all-time highs, what do you call NASDAQ? I mean, seriously, what do we call the S&P 500 then? And then they say, well, but they have cash flows. Yeah, gold is never going to produce cash flows here. I mean, this is not a new thing. I mean, we all know that. It just amazes me that everyone says that all these companies make cash flows, but they never think about from the idea of, yeah, sure, they make, they have very profitable companies, but they're also being sold at record levels. So, there's the other side of the coin here that I think a lot of people are ignoring. You're paying up massively for those wonderful businesses. And, in my view, gold is far from being over-owned, overbought, or anything along those lines. Lots have been focused on the correction here recently. Yes, we'll probably see some digestion here and so forth. I think we're literally in the midst of a monetary realignment, um, using Scott Bessent's own words, and Treasury Secretary of the US. And yeah, I think this is not the time to be, focused on that type of commentary, from that gentleman. I really think that that's very misplaced and something that will be proven wrong over the years. But we'll see with time.
Yeah, I appreciate your thoughtful opinion on that, Tavi. Central banks, we know that they have been buying up a lot of gold lately, putting it into reserves. But the thing is, when you look at this year-to-date timeline, we see gold up some 50%, we see silver up some 60% or so, platinum up some 70% or so. Why do you think that silver and platinum are outperforming gold?
I think the cycle has begun and the train has left the station. We're still in the early stages of that, but yeah, I think it makes sense that the derivatives of gold, once you truly check the box that gold is in a bull market, then people start feeling confident taking risk and going down the path of a higher volatility instrument like silver, platinum, and others. And I think that's just the beginning. I think that's just gold to silver ratio still sitting at around 80 is a outstandingly bullish metric to be watching. Um, I often hear that that's not going to be reverting to its mean because silver is now very industrial. What a dumb comment. I mean, seriously, we're just adding demand to the metal, if anything. So if you think about the equation of supply and demand, we just added another factor for the demand side. How can that be negative? Right? I mean, it's just really dumb point. If gold is back at $500 an ounce, which would be a crazy world. I don't think we're gonna ever gonna go there. Um, do you don't think that gold would be used for industrial purposes? You're out of your mind if you don't. I mean, it's just amazing how people tend to twist stories as these metals are not useful for anything. If silver was not being used for industrial purposes and it was trading at $300 an ounce, everyone would be saying that it's not useful for anything, which is couldn't be further from the truth. Gold itself, going back to gold, is probably one of the most useful metals in the world, probably the most useful metal in the world, which its properties of being the most useful metal is exactly why it became a currency, on top of also being very rare. Um, and it just amazes me how people twist narratives like this. And so this is just the beginning of a silver bull market. I think we're going to see in the next 6 to 12 months a major move in silver prices, to new all-time highs with authority. I'm not talking about 50, 55. I'm talking about adding 20, $30 to that and staying there and then moving higher, over time. I do think we're going to see that in the next 6 to 12 months. So focus remains very highly on what's ahead for these companies because I think it's going to be a wonderful place to be investing in the silver space.
Yeah, I agree with this too. Tavi, you touched on supply and demand and prices to an extent. We're seeing demand outpacing supply in silver and platinum, especially. And I want to ask you though, In your opinion, especially with platinum, where will prices, let's say, be or have to be to instigate demand destruction?
I think the only way to think about that is availability of liquidity in the world and availability of, you can make a call that a certain price in platinum or silver or gold would be the peak of the market if you know that the large driver of that has been the expansion of money supply itself. And so you have to have a view on that first. And money supply is being forced to expand because of the amount of debt. And so we either have to revalue these things at levels that are in line with where we are with money supply. Like, if I tell you where gold would be in a very crazy world, and I don't want to be quoted on this, and I'll just share with you my 2 cents of a very, you know, a, a real analysis on where gold prices would be if we're just saying, all right, we're going to go back to a world where treasuries, because if you think about this for a second, just as an exercise, it's important to go back and say, all right, well, what would be the optimal gold position that the US government would have to go back to standards that they should have during times that we have debt as extreme as we have today. Now, I know the world was in a very different place in World War II, but we need to consider the fact that the dollar kept some stability at that time because of its ownership of gold, not because of its military strength. Military strength became an argument more recently because of the fact that we have not added more gold ounces to their their reserves, the U.S. reserves, despite the fact that money supply has grown so much. So people tend to say that the U.S. dollar is backed by the U.S. military force and other things. And it's just an absurd commentary. It's just crazy to say that. Crazy. Um, Ultimately, a currency is anchored by the value of hard assets underneath. And you can't have that, today. If you go back to the 1940s, we used to have about 40% of the US debt worth. We have about the same amount of debt to GDP levels as today. We're a little bit worse today. And if you think about that, we used to own about 40% of the government debt in gold, right? That was backed by gold. If we go back to that world of 40%, again, it's going to be sound crazy, but you get to a world of about $50,000 an ounce in gold prices. $50,000. Now I wanted you to think about where would silver prices be if we do the same measurement and assume that silver will not go back to its mean or median over the last 300 years, but let's just say over the last 100 years or 50 years, which is a much more conservative metric, and say that we go back to 40 on a gold to silver ratio, or 50, okay? Not 20, not 10, of which I think we're going to get to, but let's just use a conservative metric. Where would silver be trading? Where would platinum be trading? And look, I think those are very crazy, extreme scenarios that maybe we could get there, but that just gives me more perspective about where we could be. Where would be the price at supposedly near a peak level as of today? And notice that 5 to 10 years from now, it's very unlikely that money supply will contract. If that is going to be the case, then you have to adjust your future gold prices. So the way you manage money into this is you just think about, all right, um, that's one thing. Then you have to think about other demand factors for commodities. AI is a true, it's extremely infrastructure intensively, endeavor. You have onshoring. You got to create capabilities in the U.S. and other societies that don't want to be depending on other societies too. And how would that look like in terms of investment and construction? Governments are all with debt all the way to their neck, so it's going to have to come from private sector most likely, and it's going to create demand for materials. And so, I this is why I think it's so short-term thinking of most guys looking at these types of near-term volatility and trying to claim as as if they know of anything that's going to happen in the next 3 months or so, when you have such a massive tailwind for all metals. Everything leads to metals basically. And yeah, I mean that's the I think our biggest risk is to be too cute trying to time things perfectly. Just own the thing. Just, keep looking for ways to improve your portfolio rather than trying to time a correction of 10, 15% in something that is a massive tsunami coming, and you're just trying to figure out what's the next small wave going to be. It's just weird, just how people don't think that way. And that's the billionaire approach, not the millionaire approach. That's the billionaire approach. It's just looking at the big vision and staying in, not moving. And so that's the way I'm trying to approach this as well.
Yeah, Tavi, with you touching on that, I start to think about asset class rotation strategies and how important it is to understand this strategy. And I'm bringing this up because, at least with precious metals, here with our company, Auctus Metals Portfolio, we do optimize these portfolios of precious metals built on gold, silver, platinum, palladium, and even rhodium. And I'm curious because I want the viewers to know, with Crescat Capital, is asset class rotation also a strategy mix for your clients?
Oh, we're always looking for what's cheap, right? Then there's always something in within the commodity space that is cheaper than the other. Does that mean we're massively rotating out of one thing and another? I don't think we'll ever in the next 5, 10 years rotate completely out of gold unless there is a change of the macro view in regards to what's happening. Um, but I am not opposed at all to giving a higher relevance to a certain metal in certain times. Like not too long ago, we were extremely focused on zinc. We thought zinc was really underperforming other parts of the market. There's always going to be parts of the market that will be underperforming in the commodity space. In the metals space, I would say nickel right now looks really attractive, and is likely to have a major comeback. So that's one part of it. Does that make me want to have 100% nickel? No, that's not what I'm doing. I'm just saying, if I can find a few nickel stories that make sense to increase exposure to that, I think that would be a good outcome. Secondly, I would say that copper looks incredibly attractive right now, as well. I think it's in the process of a major breakout. And I spoke about silver. So I just think that you don't want to overtrade these things. You sort of want to be always looking for cheap ways to upgrade your portfolio. Of course, every day you wake up and you look at your portfolio, am I owning the best things I should own? And keep asking that question over and over again, and making sure you really have conviction on the things you have. I think that's a normal, you know, portfolio management ability that you should have. And but without taking your eyes out of the big picture. I think that's definitely, like have a very strong view on oil right now. Very high conviction that oil and oil companies should do quite well in the next 12, 24 months. So yes, I'm giving a lot of um, prioritization to that theme to be a big part of a portfolio. So I think that's a smart way of playing the commodity space.
Okay, I want to touch on the USD for just a bit because it seems like just a few months back, we saw the USD was down some 10% or so year to date, and it's roughly down some 7% or so year to date. But when you pull back and look at a longer term chart, you see that since the 2008 financial crisis, you see that the US dollar is actually on an upward trend where it's still creating higher lows. So I wanted to ask you and know what's your take on the US dollar and what's your outlook for it?
I agree, and I think that certainly is still the case that the US dollar has been doing higher lows. I do think we're going to break that trend in the next 6, 12 months as well. I think that's an imminent and inevitable move that will change the market as well. I think we're just seeing digestion at a very important support, but that support is poised to break, in my view. And the main reason for it is because the largest imbalances we have in the US relative to the rest of the world. The US has a problem that the rest of the world doesn't have. And it's not debt, it's related to that. It's how much they're paying to service the debt relative to GDP. No other country that is large in the world is paying 4 to 5% of GDP every year to service its debt. No other country. So if you're going to go back to a global standard of 1.5% or so, the only logical way you can do that, there's two options. One, you reduce debt massively. No way that's going to happen, in my view. Or two, you lower rates to back to 1% or something along those lines. Very likely to happen. So I think, today the probability for the next 2 years of the Fed funds rate is at about 3%. And that assumes no recession. That assumes no, major issues with the bond market. I don't think that's going to happen. I think we're going to go back to a 1% or lower world. And if that's the case, you know, plan accordingly, because what does that mean for hard assets? When you really reinforce fiscal dominance and financial repression, not suppression, it's going to be, I think it's going to be very severe what we may see in terms of repricing of commodities overall. And if you think about it, the commodities index actually peaked almost precisely when the Fed started its hiking cycle recently in 2022, almost precisely. And now we're seeing the commodity prices index equal weighted about to make new highs at a time when the Fed is now starting to cut rates. And again, I think that what has been priced in markets today in terms of the estimates of where Fed funds rate will be 2 years from now is very wrong. I think it's going to be 200 basis points lower at least. And that's a huge difference of views. And I think that will be happening in the next 12 to 24 months. So that's me just, telling you what I think, but I think it's an important change that is not priced in markets.
Tavi, you think we're going to go back and see QE or maybe the repo markets getting active again?
Very unlikely that we're going to see QE on the form of QE because of how much people have, you know, basically spoke against that policy. We're going to see QE like policy that's going to be named as not QE, essentially. I think that's the bigger probability in terms of outcomes. And buybacks from the treasury is going to be a likely outcome as we revalue gold and gives more cash for the treasury to be able to buy back its own treasuries. It's going to be some very funny policies that don't change the thesis at all. It's just going to be expending more monetary and the money supply, monetary base and money supply. And yes, I mean that's the big I think elephant in the room here is how we deal with this debt conundrum without expanding our money supply substantially. And there's no way around that, I think. I think you can see a depression if you want to go back to a, you know, uh, a world where we're going to fix the dollar in a certain gold price, I highly doubt we're going to see that because, you know, in that world would apply that we wouldn't be able to print money anymore and do other things. And that's what's called a depression, not a recession. And in the world that we are in today, right? Like the only reason why we're growing, it's not because of AI, it's not because of technology. And I know a lot of people like to say that. Just look at how much we're spending on the fiscal side. It's not American exceptionalism, it's fiscal exceptionalism and fiscal irresponsibility at the end of the day. And that's what's driving this bus, basically. And I don't think, yeah, I don't think this ends here.
Tavi, you know the mining space pretty well, and they're getting, I'll just call it relief with higher metals prices. What are you hearing from the miners, the mining sector, and have miners put enough effort, or let's just say capital, into exploration?
Perhaps better to hear what's the investors saying. What are the investors saying in regards to uh, earnings releases that we had recently? The Newmont, I think, was a great example. Newmont put out outstanding results, and everyone was saying, "How in the world the stock is down when they put out these incredibly profitable earnings releases and so forth?" And the main reason is because they disappointed on guidance of production. So the market is telling them, guys, you have zero growth in the next five years. There's no growth here. Where is this going to come from? Like, yeah, sure, you're doing great. It's a good value investing proposition to allocate capital here, but you're not growing. And I think it's remarkable about how these CEOs are usually wrong about um they're always late to the party, these CEOs of these large companies. I don't remember which CEO was, but I remember hearing um that I think it was Palmer. Maybe I'm wrong, not to name anybody really, but that said something along the lines, we're not focused on volume. This was a few years back when gold prices are still trading at 2000 or so. We're not focused on volume right now. We're focused on cleaning up our balance sheet. And I was like, this is the only time should be focusing on volume. This is the time to be focused on volume. Look at your reserves, and gold prices are about to explode. Look at your reserves, and you should be, laser focused on volume. So my view was that the exploration industry at that time would be receiving capital from these guys because of because of investors starting to pressure them to grow. And the view has been delayed. We've done fine. We've done very well in our funds, but um, not exactly the type of M&A transaction I thought we would have seen in the last 1 to 2 years. But I think it's coming. I think that the fact that these guys are saying you need to grow, they have a few options. They can invest or increase their exploration budget, which remains at some of the lowest levels in history, despite the fact gold prices are where they are. They can, but they can also, and that takes time, finding new discoveries and all that. It's not an easy endeavor. Or they can just start to acquire smaller companies that are still trading at cheap valuations. And so that is the likely outcome. That's the easiest outcome. Right now, we've seen enough transactions happen across the themselves across the majors. So majors buying each other out or merging and so forth. It's a matter of time for that to, or it's already happening in some cases, but we're going to see a lot more of this integration between the larger companies and the smaller companies. And those that own high quality assets that have been proven to be deposits that are going to become economic, I think are going to be in high demand here. So yeah, finally the market is waking up and saying, "Where's growth here, guys?" And just watch the CEOs change their view. It's going to be fascinating because these guys don't have views. They're forced by the investors to form their views on whatever investors think it's supposed to be happening. That's a change in narrative that a lot of people have not paid attention to, but it's happening right now.
All right, Tavi, before we head out, can you let the good people know how they can get more of your insights and about Crescat Capital?
Sure, they can find more about Crescat at crescat.net. And they can also find more about my work at X at Tavi Costa is my handle, or you can look it up on LinkedIn as well, and you'll find my handle there as well. Just Tavi Costa or Tavi Costa, and you'll find me as well. Thanks for having me, Patrick. It was great to catch up with you.
Yeah, thanks, Tavi. Appreciate you being here, and I look forward to doing this again soon. That was Tavi Costa sharing his insights on the macro, precious metals, and miners. To get more of Tavi's views and tweets, follow him on X at Tavi Costa. If you want more precious metals insights and would like to know about optimizing your precious metals portfolio, visit us at www.auctusmetals.com. And don't forget, please do like and subscribe to our YouTube channel.